Hi there! In this video, I'm going to share what key indicators I use when picking my growth shares for one of my ISA portfolios. I'm Anthony and we're talking money. Okay, growth shares are typically ones that demonstrate a higher capital growth rate than, say, value or dividend stocks that typically have a lower growth rate but higher dividend payouts. I particularly like growth stocks because of that one reason, really. They carry a higher risk, but the rewards are also much greater. So, what are the typical characteristics of a growth stock? Well, fortunately, Slater, in his excellent book, The Zulu Principle, which I think is an absolute Bible in this field, lists them all out in some detail. I was very lucky to meet him in a seminar about 20 years ago, and he completely transformed my way of picking shares. The criteria of a good growth share can be summarised as follows. They are typically smaller companies with market valuations of under £100 million, usually young, disrupting companies that are growing quickly and setting new ways on doing things within their field. They have a forward PE ratio of under, say, about 20. These are, of course, estimates and they are forecasts. And I'm a little bit sceptical about the PE ratio anyway, but in general. And I've made a separate video on the PE ratio. But as a very narrow guide to valuation based upon earnings, then the PE ratio is about as ubiquitous as they come. And it's an easy figure to find. Future PE ratios are usually brokers' forecasts, which of course can be wrong, but they're probably the best thing we've got to go on at the moment. Then comes the earnings. Earnings should be growing year on year by about 20%. Typically over the last 5 years, profits should be growing year on year by 20% or more. Almost the definition of a growth stock is its ability to grow profits quickly year on year. So no surprise that this criteria is important. And then comes a combination of the two. This is where Slater is made famous, aside from his entrepreneurial skills. The future PE ratio divided by the earnings growth gives us the PEG ratio. It attempts to give us the concept of growth at a reasonable price. So a PE ratio of 20 and a growth rate of 20 gives us a PEG of 1. Anything under 1 is cheap, anything over, say, 1.2 is expensive. Shares must also have a robust cash flow per share. This is an absolute must for a fast-growing company because fast-growing companies can easily go bust if they run out of cash. Then one of my favourite all-time indicators is the return or an improving return on capital employed. Have a look at my other video up there somewhere on return on capital employed. This indicator tells us how good the company is at making a profit out of its net assets and is a terrific balance sheet indicator. And finally, if the directors are buying shares too, then that's a big bonus because if they're confident in their company and they're putting their money where their mouth is, then we can be pretty confident too. So where can you find all these amazing indicators to get all your growth stock suggestions? Well, I wish this company would have an affiliate program, but they don't. I personally think they're terrific. I won't earn a penny from recommending them. So you can rest assured that I'm not going to get rich over just subscriptions coming. But anyway, the company's called Stockopedia. They allow you to search for all sorts of shares by lots of different criteria, including the ones which we've just mentioned. They're full of guru stock screens. They cover UK, Asian, European and US shares as well under various different subscriptions. It's an exciting site. I suggest you go and have a quick look at it, see what you think. And if you've got any other suggestions for choosing growth shares, how you pick them, then put them in the comments below. I'll be interested to read your suggestions as well. And if you've liked this video, hit the subscribe button and the little notification bell. And I'll catch you in the next video. But I'm Anthony and we're talking money. Until the next one, bye for now.